Now, this is where my students who've been around a long time know exactly the right answer to this. The correct answer is, well, interest rates have nothing to do with the valuation of the property. Valuation of the property is tied strictly to the cap rate and the NOI, right? Right. So what happens to the valuation? Nothing really, because interest rates are not a variable in that equation. So why are things changing? Values are changing in the marketplace because of the increase in the interest rates. Why is that? If the NOI remains the same, why should the interest rates have anything to do with it? Because remember, the interest rates go towards the mortgage. They go towards how you finance the deal, which are all elements of items that are below the line. So above the line, it talks about the property. Below the line, it talks about the deal as an investment deal. So that's the difference. So interest rates, a change in interest rates affects the deal. It doesn't affect the day-to-day operations of the property, or so it shouldn't. But what happens to valuation when interest rates rise? Now, let's assume, for the sake of this conversation, the interest rates went from 4.5 to 5.12. The property is 1.25 million, and we're getting a 30-year 80/20 LTV. When the interest rates go from 4.5 to 5.12, the mortgage payments increased by 7.4%. The cash-on-cash return is what changes drastically. It goes from a 4.6, using the numbers that I was using in here, it goes from a 4.6 to a 2.6, a 77% reduction in return to the investors. That's what happens when interest rates rise. Now, think about the interest rates this way. We don't care about the interest rates. What we care about is the return for our investors. What do we mean we don't care about interest rates? When we're buying a property, we bake in the cost of the interest rates when we buy it, okay? When we sell it, interest rates really make a big impact because it limits the amount that investors can buy from us, because they have to justify the returns to their investors. So because of that, they need to you need to reduce the price, or they need to reduce the price to get to that same 4.6. So that's how interest rates impact the valuation. Didn't impact the NOI one iota. But when you see these rates going from a 4.5 to 5.12, this is what happens with the cash-on-cash return to the investors, and that's what we care about. So it may seem rather sophomoric to some of you, this conversation. I just want everybody to understand that this is how the interest rates impact us on a day-to-day basis. If you own the property and you got a 7-year term, this period, what we're going through right now, won't even impact it. If you have to sell the property, the person that you sell it to has to give a certain rate of return to their investors, and therefore the only way they can buy your property is if you come down on the price, and that's where the interest rates impact the valuation.